Hello traders. It's just after 11 o'clock. There's still a few attendees to sign in, but I think we'll get started. Welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. While I just let you have a quick read of the disclaimers, the risk disclaimer here and the general disclaimer, I'll briefly run through some of the key objectives of this webinar. So we think markets are generally driven by major themes which buyers and sellers, traders, investors, market participants relate to in order to enter and exit markets. These stories or narratives can be long-term or short-term in nature, can be fundamentals, technicals, political reasons, geopolitical reasons, any other reasons which will increase or decrease in importance over time. To kick off the webinar, we'll look at the key theme of dollar strength. We'll do a quick 101 and learning point around central banks and interest rates. We'll also look at a key tool that many traders use around the Fed, the US Fed and the FOMC. We'll then check out the risk calendar this week and especially the one major risk event kicking off with the release of the US CPI data in a few hours' time. And then we'll wrap up looking at a few of the majors, euro dollar, cable, so sterling dollar and the Aussie dollar. Our goal is to break down all the market jargon and complexities that we read about. So if you have any questions, please do ask them away and write them in the box below. And I hope to answer them as soon as possible, or at least after the webinar finishes. It's Wednesday, May the 11th, just after 11 a.m. in London. So let's get to it. The first and a major market theme we want to look at is dollar strength. And we use the DXY chart, so that's the US dollar index chart. That's the most widely recognized currency index and the leading benchmark for international value of the US dollar. Now, I'm sure many of you know this is a weighted index that's made up of a basket of currencies used by US trade partners, and there's 6 currencies in total. So the euro is has a predominant weighting in this index, around 58%. Next is the yen, around 13% or so. GBP sterling is around just under 12% of the weighting of the DXY. And then we have 3 other currencies, the Canadian dollar, around 9%, and then the Swedish krona and the Swiss franc make up the rest with 3 to 4%. So a predominant weighting, as I say, of the euro is seen in the DXY. And we can see on this monthly chart the prices really have been ranging for the last few years between 2015, between 90 and 100 that we can see here. And we've broken out just briefly to the top side and then below the 90 region a few times, and then obviously we've had this major move to the upside recently this year up to 20-year lows. So the greenback really has been reigning supreme. It's up over 16% in the last 12 months alone. It's up nearly 10% this year and over 5% in April alone. And there's numerous reasons for this. And I think we've seen numerous headlines as well around King Dollar. So why do we call it King Dollar? Why is it known as King Dollar? Well, it's the reserve currency for international trade and finance, and it's really the bedrock of the global economy. And that's confirmed ultimately by FX reserves, which are held by central banks, with the dollar share being nearly 60% of those reserves. That is down from over 70% in the year 2000, but it's still roughly 3 times the second place euro. I think there's three major reasons for this dollar strength, especially seen in April. We've had expectations for an increase in US interest rates. So the US Federal Reserve has embarked on a tightening policy, and we've seen that big increase in US yields especially. This also plays in to the fact that growth expectations elsewhere have been cut. So they've been cut in Europe and Asia, and especially China. And the third reason is due to that safe haven bid on geopolitical reasons and on weaker stocks. And we've especially seen the weaker stocks this week. And it's that risk off move. So it's the risk off move where the dollar really can appreciate. If we think about it, the dollar correlates inversely with risk sentiment and inversely with global growth. So when we have weaker growth, we generally have a stronger dollar. Investors, traders flock to the US dollar as the main reserve currency, as I said, for international trade and finance. And I think at this point, it's a really good idea just to step back a bit. And as I mentioned, I'm keen to do just a little education point, if you like, on something that I think is obviously really important at the moment. And that is around central banks and interest rates, their impact on foreign exchange markets. So who determines interest rates and monetary policy? Of course, it's a country's central bank that does. And we think of the US Federal Reserve, we think of the Bank of Japan, the RBA, the ECB. And their views on the economy and price stability are crucial for markets. And we've seen this especially in the last few months. By price stability, we mean prices should neither go up or down too fast. And the result then is only moderate inflation, which is that steady rise in prices of goods and services, which comes with moderate economic growth. So central banks will raise interest rates when inflation goes higher, and this is meant to encourage businesses and consumers to save more and to borrow less, hoping to slow economic activity. And we can see that on the left-hand side in that big green arrow, interest rate hikes, trying to slow down economic activity, which will hopefully bring inflation down in the medium to long term. Of course, if you see, say, a higher interest rate in a savings account, you're more likely to put your cash into that account rather than take out a loan, which has just become more expensive. And for FX markets, similarly, companies, investors, commercial banks, they'll seek out countries with higher interest rates and solid and growing economic activity. And this means there'll be more demand for that currency, which comes then which causes the currency to strengthen. And key to this is knowing what is expected around monetary policy and around central banks and any future changes in that policy. And I think the tool that I mentioned before, which is really crucial for traders, that many traders use, is something called the CME Fed Watch tool. And this is, as I say, used by many to track what the Fed is expected to do. And it uses Fed funds futures rates, which are being relied upon as a really useful indicator for pointing where Fed funds, where US interest rates will go. And we can see really it analyzes the probability of FOMC rate moves for upcoming meetings. So you can really visualize both the current and historical probabilities of various rate change outcomes for a given meeting date. And you can see on the left-hand side here, you've got the current target rate. You can compare that with previous times, so a day ago, a week ago, a month ago, and you also have a probability matrix as well, which is really useful for just tracking what happens in time. But before we get to those, I'd just like to touch upon one of the where we come from, actually. And you can see on this historical chart here this really shows us the probability again of those Fed fund rates. And we can see just before December of last year, it really was a coin toss. It really was a 50-50 chance of a 25 basis point move, or even of keeping rates where they were. And obviously, even in March, so not so long ago, rates were still at 0.25%, so still at 0.25%. And if you fast forward then to last week's Fed, well, they obviously delivered that half-point rate rise, which was expected. And that was the biggest hike in 22 years. And Fed Chair Powell, well, he hinted that the Fed will hike by 50 basis points at the next couple of meetings. And this is really trying to push the Fed to reassert its inflation fighting credibility. And if we then jump to these current expectations, we can see the probabilities for the June meeting. So, as Powell said, we've got, over a 90% chance now of another big hike, another 50 basis point hike for the June meeting. And then we can see in the next other meetings, so the 27th of July, again, another 50 basis point hike is priced in. Very small chance even of a 75 basis point chance of a hike, sorry. And then as we go through the meetings, more hikes are priced in. And I think then it's really interesting that we get to, say, the 14th of December meeting, so to year end. And we're all talking about, everybody's talking about a 3% rate there, a 3% rate by December then for the Fed to hike to. And that's called the terminal rate. And I'm sure many of you have heard this term bandied about. It's being talked about a lot. So it's crucial for investors, the terminal rate being the end point for rate hikes. So the point where the Fed funds rate will peak. And normally that's around the so-called neutral rate. And what is the neutral rate? Well, that's the rate at which medium-term growth and inflation is in equilibrium. So it's neither restrictive or stimulatory. And I think it's worth just dwelling on these moves. So the total amount of rate hikes potentially in 2022 is around 250 basis points. And if we look at the history books, well, that kind of move in a calendar year was last seen in 1994. In actual fact, the largest historical change in the Fed funds rate was back in 1979-80, but that was 400 basis points in a calendar year, 400 basis points of rate hikes. So you kind of think, well, 250, it's a lot, 50 basis point hikes. Again, they're big moves, but they're not as big as, historically, potentially the biggest ever move. I think you have to bear in mind really where base rates were then. So back then, and arguably a 100 basis point move from a 10% base rate is going to have a lesser impact on tightening financial conditions than where we are now, where you see a 50, 100 basis point increase from base rates which are below 1%. So when you rescale back to the starting points, I think that this year, 2022's expectation for increase in the Fed funds rate pretty much dwarfs all historical precedents. And I think we really have to remember what is really historical huge moves in interest rates from where we are and where we've come from. If we just flip back now to the dollar chart that we looked at before, the monthly dollar chart, we can see we're really at 20-year highs now. We're overbought on the monthly chart, and if we drop down to the weekly chart, we're also overbought there, overbought on the RSI, which I'll touch on briefly a bit later. So that it's probably not. It's probably pretty expected that we are, of course, in those overbought conditions as we've had such a strong move. And since finding that support from the 90 area, again we moved up, and we're now in this sort of resistance zone between the 2017, the January 2017 high, which if we go back is here at 103.82. This is on the DXY. And also between the pandemic March 2020 high, just below 103 at 102.99 there. So we're in this resistance zone at the moment, and we've cut through. You'll see we've cut through a long-term trend line resistance from the 2002 top there, which you can see a really long-term resistance trend line touched on the March 2020 high as well, and we broke through. We cut through that in April of this year. So really good to see how these interest rate expectations have pushed up the dollar. And I think key going forward, there's a few issues. So firstly, this front loading, again, probably a new phrase to some, front loading of interest rates, which means the Fed is trying to push and move the interest rates really fast, really quickly at the start of the cycle. And they're really trying to get a grip on inflation expectations. But we have to remember that faster, sharper interest rate increases obviously come with a greater risk of an adverse reaction than would, say, a slower, more gradual move in interest rates. And I think we're seeing early signs of that. If you read some of the headlines around the US housing market and 30-year mortgage rates, which have jumped above 5% now, 5.27%, I think, from where we were a year ago, where they were 2.96%, so below 3% for mortgage rates. Another issue as well is that, as we've seen, markets are already pricing in a Fed funds target rate, which is near the upper end of the neutral range. So this kind of suggests to us that rate markets are fully priced, more or less. So do we get any additional lift from that interest rate story for the dollar? Depends obviously on your point of view. Potentially, obviously, we can go further than that terminal rate of, say, 3%. If we went to 4%, then certainly we'll get even more dollar strength. But I think a sustained fall, therefore, in the dollar, that will only come potentially with this a more orderly normalization of Fed policy. And that then would give us more benign conditions for global risk to flourish. But we're probably not there yet. And we see that in divergent central bank action. And few currencies really can compete with the dollar, can compete with the interest rate differential. So those differences between bond yields, between government US Treasury yields and other government bonds, other central banks, which are not going as fast or not front loading those interest rates. And especially that contrast is seen in Europe, where obviously we've got the Ukrainian conflict foremost in the minds of many, and we've got potential that the risk of an abrupt cutoff in Russian gas, and that really is harming European growth prospects and the toxic mix that we have there, which is of this stagflationary shock. Stagflation, what is that? So that's obviously slow growth that we're seeing, but obviously high inflation, high energy costs, higher commodity prices. And that really is troublesome for the ECB in Europe as to what they do. Additionally, in Asia, they're dealing with their own growth problems. So the likes of China and Japan are still in easing mode, and China especially with their ongoing fixation really of the zero COVID policy, which is really instrumental for them at the moment, and that's leading to growth downgrades and the supply chains which we hoped would get freed up are obviously still snagged and still an issue there. So yeah, the contrast between other areas of the world, other parts of the world, is quite stark at the moment, and that's why again we've seen dollar strength. I think, as I mentioned at the start, we should touch on a review briefly of non-farm payrolls last week. A few takeaways there. Obviously, the headline rate 428,000, was broadly in line with expectations, despite a few negative revisions. Crucially, wage growth, it did moderate, but it's still above pre-COVID levels. And so the overall picture, well, we can see the overall picture on this chart on the headline figure at least. We're still just shy of the pre-COVID level, around just over 1 million jobs shy of the pre-COVID level. But the overall picture is of a tight labour market. And what does that mean, a tight labour market? Well, it's a labour market in which employers are competing for workers. So in one in which demand for labour is at least as strong as supply. And what do we get there? So we get low unemployment, we get record high job openings, but many unfilled job vacancies. We also have labour force participation, which is still subdued. We haven't got all those workers which left the labour force during the pandemic. They've not come back, and therefore you've got solid wage inflation. And that whole picture continues to support the case really for Fed rate hikes going forward, at least in the next few months, and giving support therefore to the dollar. If we just move on then to today's main event and this week's main event especially, that's US CPI. All eyes on those numbers at 1:30 UK time. This is probably now singly the most important data for global markets. And we can see on this chart, it's quite an interesting chart really, a very simple chart in a way. CPI prices, this is for the headline rate. So they pretty much tracked, meandered around 2% from 2016 through to early 2020. Then, of course, we had the drop in CPI, headline CPI at least, due to the pandemic. We had 3 months, I think, of negative prints there. But since then, obviously, with all this stimulus, which global central banks, fiscal, monetary and fiscal, obviously, as well from governments, has pushed prices up, pushed energy prices up, petrol prices up, food prices up, and potentially whey prices up as well. And we've seen this growth up to 40-year highs, multi-decade highs for US headline CPI, the last print being at 8.5% in March. So what's expected today? Economists polled by Bloomberg, they forecast prices increasing at a pace of 8.1% year on year. So prices still close to the multi-decade highs, but it would be the first slowdown in pace since August 2021, which you can see on the chart there actually. So the key question really, has US CPI peaked? One other area of the data which is important will be the core reading, and we can see on this chart again tracking sideways for many years around 0.25. It was quite an easy an easy guess for economists to put out there. Core inflation kept around the 0.25 area. Obviously then we've had massive volatility in this number. The core, if we take a step back, that strips out the effects of volatile food and energy. And it's also expected to slow. So compared with April of last year, so the annual year-on-year rise is expected to slow. But the monthly rise or the monthly number, that may show an increase of around 0.5%. So potentially this data is absolutely huge for the Fed and for global markets. It's one of 2 consumer price reports that will be considered by the Fed at its June meeting. And obviously a big deviation in either direction could potentially change that pricing for those rate expectations and also for dollar direction. I think if we do get a print around that 8% mark, then we may see some short-term respite. We're seeing that already this morning, potentially in the dollar pulling back slightly, but we'd probably have to get a sub 8% mark really to see a more prolonged drop in the dollar and potentially a firmer bid to stock markets. There are obviously still concerns, or new concerns even, around food prices and services inflation. And we've obviously still got the zero COVID policy that I touched upon earlier in China, which is still causing supply chain issues, and meaning that the pace, the moderation of this decline, which we might see today, we're expected to see today, that may be very slow, the moderation. And if we think that the upper end of the Fed's inflation target rate is, well, 3%, 2 to 3%, and we're obviously a long way from there. I think now is a good time to really look at some of the majors then. And firstly, euro dollar, which is obviously the world's most popular traded pair and the world's most popular traded currency. Again, I think it's always good to, well, firstly look at the fundamentals briefly. We can look at market pricing. There's roughly a 20% chance or so of a move in June by the ECB to hike rates. The first 25 basis point hike is most likely in July, and then there's approximately over 3 more hikes in total. Sorry, 3 hikes in total, which means probably 1 in each meeting of this year through the 3rd and potentially 4th quarters of this year. So depending again on your point of view, we kind of think there's not that much room for more ECB rate hike bets. Is there much on the calendar to look forward to? Well, not data-wise. There are a lot of ECB speakers out today and this week, and they have been in force, and the hawks especially have been getting louder. The hawks, obviously, those are the ECB members, the governing council members that favour higher interest rates to keep inflation in check, and they are traditionally from Northern European countries, whereas, say, the ECB doves, they prefer interest rate policy, which is more accommodative in order to stimulate spending in the economy. And again, traditionally, they're from generally from Southern Europe. But we have heard a lot more from the hawks recently. They're getting louder along the lines pretty much of we're talking too much now and we need to act. And the preference for a lot of them is for a June hike before summer. Remembering that Eurozone inflation is at record highs. It hit 7.5% in April, and that was the 6th record high in a row. For Eurodollar then, well, the broad tone is still this dollar strength, which continues to play a really important role, more than, say, some of the intrinsic drivers. Even when we've had this hawkish rhetoric from a lot of the speakers, ECB members, we still haven't really seen any kind of strength in the euro. So reinforcing that broad dollar tone. Although definitely developments on the energy front in the coming days, and if there's a potential agreement on some sort of Russian oil ban, that will affect the currency. So technically, we can see on the chart finally, longer term on this weekly chart, a really nice descending bear channel. So a series of lower highs and lower lows from that May top at 122.66. We then had that breakout of trend line support in April around 108. If we go back, we can just see that trend line support line from way back in January 2017, touching the pandemic low around 106.36, and we pierced that long-term trend line support around 108 in the middle of April, and then we've obviously fallen below that. Interestingly, if you think of the DXY, and we touched on that long-term trend line resistance, if you just flip that chart on its head, then you kind of get the euro-dollar, a semblance of the euro-dollar chart because of that big weighting in the DXY. What should we look out for now? Well, on the daily chart, obviously, we can see that break of the 108 level. We consolidated around there, having tapped it once in March, and then really that was bearish consolidation. So slight narrow ranges, and then in line with that long-term dominant trend, we saw a break to the downside. Levels below, as I mentioned, that 106.36 pandemic low, and we've had consolidation. Having broken that level, we've now got consolidation again below there. So 106.36 is acting as resistance. It was support obviously before, and now resistance. Below here, where do we go potentially? You've got the April low, which was 104.70. And we'd really need a weekly close above 106.36, I'd say, to arrest some of this bearish momentum, to have even a look at that 108 level. Just touching below 104.70, then we do have a 2017 low at 103.41. Moving on to cable, so this is pound against the dollar. We can see, just flipping back to the month, the weekly there. Just before I look at the chart, actually, we'll just think about some of the fundamentals again briefly. Recent data has been sluggish. Retail sales disappointed. GDP was just 0.1% in February, and we do get an update on the latest GDP figure on Friday. We also had a consumer confidence number, which was near record lows. Importantly, obviously, the Bank of England was last week. They hiked rates as expected from 0.75 to 1%. That was the fourth straight hike. And the MPC, the committee, did signal their concern over higher and stronger inflationary pressures. But I think the main takeaway was the highlight of clear downside risks to growth. They potentially expect GDP contraction in Q4. And so it really begs the question as to whether potentially we see a pause in this tightening cycle by the Bank of England, and potentially some are calling even a top to the cycle. We have to remember, I think a really important point is that the Bank of England was the first central bank, the first major G10 central bank to embark on tightening policy. So potentially we could see a slight pause going forward. The market's pricing still around 85 basis points of increases by year end, so that would give us a terminal rate closing in on 2%. So quite punchy there. Regarding the technicals then, cable, again, we can see dollar strength to the fore from that April top, really April, May 2021 top last year around 142.50. We've had this sort of shallower, slightly more shallow bear channel than seen in the euro dollar. And we found support around 131.60. We can see there in December of last year, and then around 130. Just flipping to the daily chart, we did push up slightly once we had touched the 130, a massive psychological level there. In March, we did push up above 132. Yes, again, bearish consolidation, similar to the Eurodollar chart, as I say, and the longer we had prices tracking along that support, along 130 in narrow ranges, then we had a breakdown in line with the long-term trend. So for lower prices, and especially that 130 psychological level. The break actually, that took place on a Friday, so very ominous, very significant for technical reasons. A really weakly close on that Friday. I remember UK retail sales coming in disappointing, and really the trigger for the realization that the UK consumers especially is going to struggle going forward with the cost of living crisis, among other price rises, really. Cable, yeah, so it's had a big drop, 7 to 8 cents or so in 3 weeks, and it had 6 consecutive days of losses that we can see here on this bottom indicator. 6 consecutive days of losses. We've not seen that since June of last year when we hit 142. We did then consolidate around 125, so another key psychological level. 130 down to 125 very quickly, short space of time. So naturally we were going to get some consolidation. We did have oversold conditions there. I did say I'd touch on actually this oversold condition. It's the RSI indicator. I'm sure many of you might be aware of. We really like this momentum indicator. It measures the size of recent price changes to analyze, as I say, overbought or oversold conditions. It's a really simple and easy to understand indicator, I think. We oscillate between 0 and 100, so an overbought condition is 70 to 75, oversold 25 to 30. And we use it to identify general trends, and we can look at, say, divergences, so differences with the underlying price chart. And we might see potential patterns which we don't see on the underlying chart again. I know some people think, well, the timing for price reversals can be unpredictable. And also, we can't forget that, yes, we do, or we can trade in overbought, oversold conditions for some time. But I just thought I'd run through the RSI there. We use it and quite like it. But yeah, so cable, sterling, dollar is tracking bearish consolidation again. It looks like still below 125 area. It's tried to push above there a couple of times and hasn't been able to. Targets to the downside, there's a June 2020 low at 122.51 around there. And then after that, well, you've got the August 2019 and the May 2020 low. That's sort of similar levels around 120.76, that area. But really then many citing the 120, so another pivotal psychological floor below for cable potentially. The other major I think is worth looking at. We've seen a drop in commodity prices, and that has affected commodity currencies a great deal. So Aussie dollar is really worth looking at. It's hit a massive support level technically. So we'll look at that in more detail in a minute. I think fundamentally always interesting to touch upon for me and for us here. The Aussie, obviously a commodity currency. It's a high beta cyclical currency, so it has a very strong correlation to global risk appetite. And when risk is doing well, risk on, if you like, we're in risk on mode, then the Aussie will generally appreciate. But obviously, in the last few weeks, we've seen that risk move really sour, and that's hurt the Aussie. It's hurt the Kiwi, the New Zealand dollar, and also the Canadian dollar. For the Aussie especially, the AUD is largely or hugely dependent on commodity prices. As I've said, Australia is the #1 exporter in the world of iron ore. I think it gets around half of its overall exports are from iron ore. It's also the #2 exporter in the world of coal, so hugely dependent on commodity prices. And also then China. And we know recently China is struggling with the growth outlook, and then also that means that's feeding down to the demand outlook. On the flip side, you have those negative external factors. The internal factors, especially for Australia, concerns the RBA. So again, looking at pricing for interest rate hikes there, they've just embarked on quite an aggressive, well, a relatively aggressive period of rate hikes. They hiked by 25 basis points last week. And they were quite bullish in their assessment of the economy. I think they called the economy, it was proving resilient. Inflation was increasing more quickly and higher than they had expected. I think one thing to note with the RBA especially, they do have more flexibility than other central banks. So they can take a slightly more cautious approach to raising rates, essentially because they have more meetings. So they have 11 meetings per year, whereas say the Fed, the Bank of Canada, they have 8, and the RBNZ, they have just 7 meetings. So that could be a quite interesting factor for the Aussie, where essentially the central bank is not raising rates as much as, say, the front loading of the Fed. Technically then, we can see on the weekly chart, we topped out in April, at the start of April, with this shooting star candle, really notable candlestick pattern there. So that's a trend reversal candlestick. So it's bearish in nature. It has that long upper shadow, and then little or no shadow below, with still a small real body near the day's lows, and that's or the week's lows even. So again, an ominous sign on the weekly candlestick there, and we can see then a few weeks, 4 or 5 weeks of straight losses, and even that green candlestick, which managed a very small higher close on the week last week. Again, we had that long upper shadow warning potentially that buyers, sellers really were in on the front foot. If we drop down to the daily, we can see then the move, especially that post FOMC move, with a support, which again, the 200-day moving average I have there in that black line, we couldn't quite get up to the 72-73 level, and we collapsed really quickly after the FOMC. And again, well, 4 straight days of losses, which has just taken us through to this key support level, as I mentioned at the top there. And we can see, if we just flip back actually to see how important this level is, just got a Fibonacci there as well, so excuse that, but we can go back to 2015 or so, late 2015, 2016. We can see, well, back in August actually, then January 2016 through to December, late December 18, and then even then around September, November 2020, November 21 again, and now more recently, we've seen those lows touched, as I said, in November, and then this year, January, February. Just talking about those lows, how many there are of them, how many times prices have been supported by that level, really shows how important it is, I think. And we could see, yeah, on the daily, especially, yeah, we touched there in February, and we're trying to claw back. So we did break through it on Monday when there was a bloodbath in risk sentiment, especially in stocks. We had that doji candle, really interestingly, yesterday. So indecision really below that 70 level. And then now we're trying to claw it back. So it'd be really important, again, I think the weekly close here for the Aussie dollar. Levels below would be potentially the January 19 spike low, which is at 67.44 if we do actually break the 70 levels decisively. And I did leave on, as I mentioned, the Fibonacci level, the halfway point of the pandemic low, and then the February 2021 high. That halfway point is around 67.56, so near that June 19 spike low. So some really interesting levels below, which we could see quite sharply if we don't hang on to the 70 level. Otherwise, we need to get back buyers above 71 to really stop this downward momentum. Right, I think we have covered quite a lot in a very short space of time. I have touched on fundamentals and technicals. We've looked at some of the key drivers of markets that we think are important at the moment, and of course that dollar strength. I really hope you've enjoyed it. Thank you for attending, and I look forward to our next webinar on May the 25th in a couple of weeks. All the best, and good luck trading out there.